Hi, this is Andrew from Pitchboard. I had a great conversation with George Pino and Joe Killinger of Commercial Brokers International. They discussed why they think real estate is a good long-term investment, the ideal amount of leverage to use, and what potential investors should know before buying. I think you'll enjoy our chat. Over the past 30 years, Joe has been a real estate agent, investor, and operator. George is the CEO of Commercial Brokers International in Los Angeles and has been a business partner of Joe for 30 years. We're excited to hear both of their wisdom today. With that, welcome to the podcast, Joe and George. It's great to have you on.
Thank you, Andrew.
Thanks for having us, Andrew.
So, Joe, we'll start with you. I gave a very short overview of your background, but I'm sure our audience would love to hear more about your real estate experience. Can you tell us how you got involved in the industry and what you're up to these days?
Yeah, as you said, George and I have been partners for a long time now. Actually, we're very specific about that 30 years. It's been a long time. I got started in just buy and flip some homes, and then I ended up working in an auction company called Kennedy Wilson out here in Los Angeles. Kennedy Wilson treated George and I pretty well. We ended up meeting there. Just decided to go out on our own after that, start our own auction company. So we actually became competitors of Kennedy Wilson, of which George came on. We ended up going 50-50 on our business 30 years ago, and we just started doing those auctions. We became the number 2 auction company in the western region of the United States within the first 18 months. That was quite a task back then because we didn't have internet. So it was all done by cold calling, and it was quite an experience. But it's led us into what we're doing now with commercial real estate. So we have Commercial Brokers International out here in Los Angeles. We are a full-service commercial brokerage. We have about 12 agents right now that we're overseeing. And then so George and I do brokerage, as well as we are investors in assets around the country, too.
And George, how about yourself? You've worked with Joe for 30 years. What else can you tell our audience about your real estate background?
Well, I've been involved in real estate for about 32, 33 years. Started off at Kennedy Wilson right out of college. They were doing real estate auctions. I was assigned Texas as my territory. I was part of the closing team where we followed up with all the escrows, made sure they closed for 1,200 properties at a time, all at one auction. So was doing that. Joe was working on the operations side, marketing. And from there, in 93, we had broken off and started the Sands Group along with Fred Sands Realtors, which was a real estate auction company that Joe had mentioned. We became number 2 in the Western region within the first year. We started investing and buying our own properties, primarily multifamily and lower moderate income neighborhoods throughout Los Angeles. We started that probably in 95 and then started buying, selling, exchanging properties. And then in the probably early 2000s, started looking at other areas to invest in and decided on the Dallas submarket to start investing. So started acquiring properties out there.
So right now, do you guys focus on commercial, residential? Do you do everything? Is there an area that you're particularly...
Our focus is commercial real estate with a focus on Southern California, but we've done deals in 36 states so far. We do a lot of triple net deals around the country.
For our listeners who don't know what triple net means, can you give us just a quick definition for them?
So triple net is a lease type that essentially means it's net to the landlord. The tenant would either pay or reimburse the landlord for all the maintenance, repairs, expenses, utilities, insurance, taxes, property taxes. They take care of everything. So the rent is actually a net amount as opposed to it's the net operating income versus the gross operating income minus any expenses. So the landlord really has no expenses other than their own internal management, which is not typically reimbursed. We tend to do a lot in the single tenant net lease market, which is really good for investors looking to increase income and a little bit more passive income as well.
Right, because they don't have to worry so much about some unexpected expense coming and
Yep.
there, yeah.
Some of our high net worth clients really like to have that, done their riskier investments earlier on in their career. They want to kind of cut that risk a little bit, and this is a good path for them to be going. So it's really for asset preservation or wealth asset preservation.
What's the advantage of commercial over residential? Why have you focused on one over the other as your careers have progressed?
I think the number one reason is commercial real estate tends to be straight business. And what I mean by that is, although cyclical, it doesn't tend to have as big of swings as residential properties. In addition to that, when you're dealing with someone, a lot of it, and whether it's a tenant or anyone else, a lot of it is straight down to the numbers. Does it make sense financially for them to be there at this rental rate? The most important aspect, I think, of commercial real estate is that generally across the board, most states treat commercial landlords or owners as well as tenants to a different standard than they would to residential. So there's a lot more residential protections for a tenant in residential properties, which can at times encumber a landlord or investor where they aren't allowed to do certain things. You're kind of at the whim of changing laws and how the social is reacting to, whether it's COVID related, where there's a rent moratorium or eviction moratorium, to wanting to put in rent control laws and throughout some cases the entire state, and so I think with commercial, those tend to be exempt from a lot of those aspects because the tenants are held to a little bit higher standard, and it's really more of a business, so it allows a little bit more flexibility, I think. At the same time, you typically have long-term leases, so you're going into a cash flow stream that, assuming all the businesses are doing okay and well, and you've done your job vetting them out to make sure there's a strong enough business to survive, going into it, what you can project out pretty good cash flows coming out for the next 1, 3, 5, 10 years. That's kind of what we like about the commercial real estate market.
And this is a fairly broad question, but why do you guys see real estate as a good vehicle for wealth preservation, especially for high net worth individuals?
I think the easiest answer is kind of using that old saying that they're not making any more of it. Real estate is real estate, and the real estate fundamentals are, as long as you abide by them and you know what you're getting into, it can be an extremely good potential for not just asset preservation, but also creating wealth as well. The main benefit with real estate is that you have the ability to potentially leverage it. If you look at the stock market versus real estate, they both typically offer about a 10% return on average on an annual basis. But at the same time, if you're leveraging your real estate and you're putting down 33% or 35% down, a 10% increase is now equivalent to a 33% cash on cash increase versus a stock market 10% increase is 10% because you're buying it all at once. So, there's definitely a lot more tools and advantageous opportunities, and there are different strategies that you can utilize with the tax laws, especially the tax laws when it comes to asset and wealth preservation. So, even zero cash flow properties are out there, which is something that a lot of people aren't aware of, but they can really benefit the right astute investor.
Something you said there actually leads perfectly into a question I was going to ask anyway, which is, what is the ideal amount of leverage to use in a commercial real estate transaction to balance the risk and reward for an investor?
I actually like to kind of, because if we're looking at asset preservation as well, now part of it is going to be fundamentals on where exactly we are, and the answer to that is a little bit more complicated, but generally speaking, 35 to 50% down is what we typically try and target and talk to with our clients. That may change a little bit based upon debt service coverage ratios and income levels and what you're acquiring the property at, as well as what kind of debt is available for that particular property and the tenant base. What's different than residential real estate is your loans vary. The types of loans, the amortizations of the loans are typically a little bit lower. They have 25, 15, 10-year AMs. When we look at all of this, we also look at the loan interest rates also in relation to the tenant, who the tenant is, meaning if I'm going in with a credit tenant that has 20 years remaining on the lease, like a CVS or a 7-Eleven or Walgreens, my interest rate will be a lot less than a franchisee guaranteed fast food location that has 7 years remaining. I mean, it can be 50 to 100 basis points less. It's a moving target, but you can definitely drill down to it when you have the specifics. So generally speaking, though, 35 to 50% on the leverage side.
Where do you think we are right now in the cycle? I mean, Are we at the frothier end or more of the value end for the commercial real estate cycle?
It's been pretty frothy lately. There's a lot of wealth that was created because of the stock market over the last year. And so you're seeing people that are coming in on deals that, and I can speak to Los Angeles and Dallas too, I guess, is that there's a lot of money chasing deals. Our agents, almost every day, they're getting a call like, listen, I've got $5 million, $10 million, $50 million, or even $100 million that I want to put in Southern California real estate. Those calls keep coming in, and you're like, where's this? There's just so much wealth chasing deals right now. So I think it's pretty frothy right now. I think when you see a little bit of an uptick in the interest rate, it'll begin to slow down somewhat, but I think it's going to take a little time.
Right, because I guess right now we've got the economy has been pretty strong, but you also have the 10-year yield is still, I don't know the exact figure, but it's 1.3 or something like that, right? So, for potential investors, it sounds like it's a bit of not a difficult time to invest, but it's a bit of a cautious time to invest. If I'm getting you correctly, that you price.
Yeah, if you're looking at core markets like, we're sitting in the middle of LA. If you're looking at LA proper, it's pretty tough. But you get into secondary, tertiary markets, you're seeing deal flow. It's happening. You're seeing deal flow here in California, but you've got to really spread it out there. You got to make sure you're working with an agent that is, or if you're doing it yourself, you got to go out and find the right deals. You're gonna have to work hard to find the deals.
Yeah, or the deal that's right for you, right?
Absolutely, because there's different types of structures on the different transaction and deals. So definitely finding the right deal that's right for you and what you're trying to accomplish and what your goals are. That's what's out there. And there are definitely deals like that in core markets as well as in a little bit more secondary and even tertiary markets. But, it all goes and boils down to the real estate, especially when you're looking at it for any type of wealth or asset preservation, it boils down to the actual location. There's that old saying again, location, location, location. And it's extremely true when it comes to any type of real estate, but especially if you're doing and looking for doing wealth or asset preservation as well, because you're looking at long-term holds. You're trying to get a little bit safer, just preserve the assets. It goes back to the one time the Rockefellers were once asked, how do you time the market? Because you just asked about it being a little frothy. Their response was, if you never sell, you never have to time the market. So, for them, they were looking at wealth and asset preservation as well as potential tax benefits. So if you're doing that, you're planning on holding for a long, long time, whether the market's frothy or not, it's still an opportune time to purchase to accomplish the goals that you're trying to accomplish. If you're flipping, it's a little different.
Yeah, you can't afford to be as agnostic on price at that point, right? Are you suggesting the clients look a bit more at those secondary markets that you mentioned, both because on a relative value basis, are those markets a bit more attractive now because of the working from home trend that people may not, and we'll see how this plays out, but people may end up working from a secondary market for a company that's based in a core market? Yeah, no, you're seeing that those markets are coming. The thing is, here in LA, I haven't seen a Class A apartment building come up for a while, have you?
Not really, no.
Yeah. So a lot of that money that was going after Class A is now going after Class B and C assets, but that's driving up the value of those Class B and C. And so, because they're all going after those now, those assets. But now out in the secondary markets, the tertiary markets, it comes down to what you as an investor are looking for. If you want to see it, feel it, drive to it within an hour, it's going to be a little bit more difficult. But if you're willing to have a property management company that's going to be in place, depending on what asset class you're purchasing, of course. But secondary, tertiary markets, yes, they do have more population living out there because there's more population there now. But there's also just some, the numbers are there. With more population, they're driving the numbers up.
No, absolutely. And part of the analysis when you're looking at, when we talked about location, we're also looking at the demographics and the growth trends for the area. So even though it's a secondary market, we're paying close attention to demographics. What's the 135 mile population? What's expected growth? What was it 10 years ago? Also income and income growth. If it's a marketplace that's secondary, that's also sliding down and has a downward trend on the demographics, it's probably not an area that we're going to look at necessarily unless it's a prime, rare, can't replace this location. There are tools when it comes to evaluating the properties, the locations, and the markets that we utilize to kind of mitigate the risk that's associated with some of the secondary and tertiary markets.
I mean, Andrew, I was just in Grand Island, Nebraska a couple of months ago in June, and there's a brand new Chipotle go in. There's a ton of fast food that has gone in there now, and that, I think the population, it's over 60-some thousand now, but there's a good number of fast food there. But, they're looking at the traffic count, they're looking at the income levels, it's all there and supporting all those.
For an investor that's listening to this podcast and they're saying, I'd like to get some exposure to commercial real estate, there's various ways to do it, right? There's directly, they can own the property themselves, they can invest in a real estate fund. What are the advantages and disadvantages of those various ways, and what do you recommend?
So it depends on how much hands-on they want to be. Now, I always suggest to every one of our investors, you need to treat this like a business no matter what. Every month, you need to be looking at your statement, see what's going on. But as far as if you're going to get into a real estate investment trust or a fund, those people have a lot of experience. Well, hopefully you want to make sure you get into one that has a lot of experience, and you want to look at their history. What have their returns been in the past? Really do your due diligence on them. Now, if you're going to go out and buy a property on your own, and if it's triple net, again, you want to make sure that you do your due diligence and make sure you know exactly what's going on in the area. Is it getting better? Is it getting worse? What's traffic count like for the property you're looking at? Depending on the asset class, of course. But you can get into a real estate investment fund or a trust for a few $1,000s. Now, to buy your own asset, you're going to need several $100,000.
So this is sort of a granular question, but for an investor that's thinking about buying their own asset, what should they know about getting title to that property to make sure that they have a sort of clear title to what they own?
Well, you're going to want to start, before you even start looking, you want to make sure you know how you're going to hold title yourself. Now, we're doing some due diligence here before. You want to make sure that as you're getting ready to buy your property, make sure your loan's in place. Are you going to be able to qualify for it? How you're going to hold title? Do you want to be in a tax-free state or, whatever, income tax-free state? You really want to have all that ahead of time. And you really want to make sure you're going to have reserves set aside. We can't tell you how many times we get into an investment, somebody doesn't have a reserve set aside. And probably okay if you get into a triple net investment, but some of these other assets, you want to make sure you have money set aside. But as far as the title, I'll let you go ahead and speak to that.
Yeah, no, when it comes to the due diligence for the title and the acquisition side, there's multiple things to do prior to. At the very base, you're going to get an ALTA survey, which then will compare it to the preliminary title report to see if there are any encroachments or if there are any other issues related to the property itself. The title and company will actually do the title insurance based upon that. So you're going to want to have legal review the survey as well as the title report to make sure everything matches all of that. In addition to that, you should also be speaking with your CPA on how you're going to take title. There are different methods, whether it's a joint, whether you're going to do it under an LLC, whether it's going to be a tenant in common interest. These all have different tax advantages and disadvantages. So a CPA is going to be able to advise you which one's going to be best for you for what you're trying to accomplish. It also depends on age and what who your partner is, whether, because some of these, the way you hold title if one of the partners passes away, title can revert 100% to the other partner, depending on how it's held. And then lastly, you want to start thinking about how are you going to protect yourself. The last thing you want to do, especially if you're doing wealth and asset preservation, is to put everything in your own name. There are different vehicles called SPEs, single party entities such as an LLC that you can create. But one of the common mistakes I see with a lot of people as well is they'll have an LLC, but they don't want to pay $800 a year to the store, however much, depending on the state, for a new LLC. So they throw all of their properties into one LLC. The only problem is you just created the same problem that you were trying to avoid by creating an LLC. If all the properties are held under one LLC, it doesn't protect any single one. Things to take a look at, make sure you have multiple different LLC potentially for every property. Another way to do it as well is another step that a lot of our high net worth individuals do is actual legal asset separations by creating an anonymous land trust, which is the managing member of the LLC. So that way they can't even track you down as the owner of that property in case you have other issues of whether it's a lawsuit or something else happening with another property. So there's definitely ways that you can do and take title to do that. But first and foremost, during the due diligence, you want to make sure that you're buying the right property and that you are getting the title. One other report I would probably recommend, unless you're extremely familiar with the area or know what's going on, is what's called a PZR, or a property zone report. They'll delve down and make sure that the property is actually zoned for the current use, and let you know what you can potentially do with the other zoning issues as well. Those are what I would do in the due diligence phase on the acquisition. And then as you acquire, then we're now looking at different ways to hold the title. And, typically speaking, an LLC is probably the most common choice, not putting it in your own personal name. And then from there, you can actually even create additional layers and levels of protection.
And on the taxes front, how do you deal with state taxes? Is there an efficient way to deal with estate taxes?
Part of that's understanding what you're looking at in that, if you're younger, some people may not worry so much about the estate taxes, but if you're doing estate planning, you're getting up in age and you're worried about that. I may end up passing away. You start taking a look at different states, potentially repositioning your assets, taking them out of states that have really high estate taxes, Illinois being like one of them, and kind of recouping that. But also what you want to do, and I think this is a big mistake for a lot of people, is that they don't plan, after I die, it gets inherited. I'm not worried so much about the estate tax because that's going to be the kids' problem, but I want them to have this asset. The only problem is if you haven't built up a little bit of a reserve to help pay for those estate taxes, the kids may have to, and I've seen this over and over, the kids may have to sell the asset just to pay the estate taxes. These are things that you want to take into account and take a look at. What is the estate tax for that particular state? How is it going to affect me on the federal side? And then from there, how can I protect it? Whether, even creating a trust where the trustee is, if the kids, for instance, or whoever the heirs are not real estate savvy, maybe they went off on their own, decided to do whatever they want, but you as the person that has built this up over 20, 30, 40 years and passing it along to the kids or grandkids, some of our high net worth individuals put this into a trust and have a trustee as, like a bank or a different person that's going to actually go over what they can and can't do, even putting exclusions on selling the property unless they have to for tax purposes. So there's different ways to structure that, but you have to really think in the future for that.
Right, because I guess
understand what your goals are and what you're planning on doing with the property. So a 30-year-old, their immediate goals are going to be a little different than a 70 or 80-year-old.
Yeah, and I guess the last thing you want is for your kids to have to sell a property in a fire sale, particularly if it's a depressed market, right? It's not going to be, these things aren't frothy forever, right?
Exactly.
So what would a typical client for you to be? What stage in life are they? What are they looking for? What sort of assets are they considering buying?
It's kind of across the board. We have some institutional investors, but we have some high net worth, a good amount of high net worth individuals. Probably, actually, I don't know if age, I've never thought about age, but probably in their 50s and 60s that have, they've worked hard all their life and want to kind of start cutting back on some of the risk and, just focused on asset preservation or wealth preservation. That's probably a majority of it.
When both of you look back, you've been in this game for 30 years or 30 plus years. If you could go back and give yourself some advice based on what you've learned as investors and operators and advisors, what would it be?
It's a very good question. Buy more. I wish that I bought more real estate when I was younger. I was just always afraid to. And I had that fear. And, now there's so many different ways. I was just afraid to do it because I didn't feel like I knew enough. And now there's so many different ways to find this information, and people are more open to mentoring you. I just think for me, it'd have been to acquire more assets.
Yeah. And along the same lines for myself, and I've said this outright to many people, when I was doing real estate auctions, I saw tremendous deals that were being done and had. As a person right out of college, I wish someone had said, you should buy some of those. Yeah. You should be buying them and holding them and renting them out. And, instead I went and did your typical 21-year-old, 22-year-old does, which is spend most of the money I made.
Going on vacation.
So, but I was getting paid very well, but at the same time, I was spending a lot of it. So I wish someone had kind of sat down and explained less of the transactional side and more of the long-term planning. Like, here's what you should be doing. Here's how you're going to get there. Here's what you're going to do to create the wealth versus transactions come and go, and then you're always chasing it. So I wish someone had actually sat down and either I came to the realization sooner or I wish someone had sat down and kind of mentored and said, you know what, this is what you should be doing. I would have had that. I think I probably would have taken that under my belt and ran with it as well.
Yeah, we live and learn, though, right? The question wasn't obviously meant to spark regret.
No regrets. You asked what we wish we had known or did before, and that's kind of what it was. But at the same time, no regrets at all. I've had, and I can probably say the same for Joe, we've been lucky to be involved in this field for so long, straight through, the entire time. I've seen a lot of agents and investors come and go, take on secondary jobs to pay bills and whatnot. We've been lucky enough to have not had to do that and have really enjoyed our career.
Okay, well, I think on that note, we'll wrap it up. It's been great to chat with you both, George and Joe. How can people with you if they'd like to learn more?
Yeah, so you can do, my direct line is 310-943-8542. Again, it's Joe at 310-943-8542 or J Killinger, Killinger at cbicommercial.com.
For myself, George here, it is my direct line if they wanted to ever reach out and call is 310-943-8536. My email address is gpino, so that's Golf, Papa, India, Nancy, Oscar, at CBI, Charlie Bravo, India, and then the word commercial.com.
Okay, great. Well, thanks so much, Joe and George. It's been a pleasure having you on. And thank you to our Pitchboard listeners, as always. We'll be back soon with another episode.